Howdy, Jacob here. Today we're looking at Cardinal Health in the healthcare providers and services industry. Just under 24 billion market cap, just over 24 billion enterprise value. They operate as a healthcare services and products company globally, incorporated in 1979. We can see massive revenue with very little gross and operating margin. So cost of goods sold is digging into 95 to 96.6% recently of revenue. And even on the operating side, after sales, general, and admin, other expenses, getting down everything but your taxes and interest and other non-interest bearing expenses, about 1%. And that is down over half, by cut in half from 2014. So we actually see revenue over double, but earnings didn't grow. So the bottom line didn't grow. That's what you're going to want to care about. You want companies becoming more efficient with the money that they're going to be growing at, because you can only grow so much on the revenue side. You can't grow greater than the world economy or whatever economies that you're dealing in. You cannot grow greater than that. And so the things you want to become are more efficient with each dollar that's coming in. And here we're actually seeing the opposite. Decline returning invested capital, decline in earnings, decline in revenue, or huge increase of revenue, but everything else not great. Balance sheet has $4 billion cash on hand, roughly $4 billion short-term and long-term debt. So we're really not concerned about the balance sheet. Cash flow statement looks pretty solid. So cash from operations has grown. Capital expenditures have also grown, though, through acquisitions, maybe a little bit of reinvestment, with the majority of their cash going towards stock share repurchases. And their dividend pays out $500 million and is 2% yield. So not a bad yield. I think that's a little bit above the market currently. And $500 million in comparison to their over $2 billion free cash flow is less than 25%. All right, so let's get to some assumptions here. I think what I'm seeing from the numbers is fine, but you're going to want to be very conservative with the margins here. So on the revenue growth side, I think with a little bit of money going towards acquisitions, probably see 6% being fine. PE for a company growing 6%, that might seem very low, but with how low their margins are, not so great. Return on invested capital, it's just, I just don't think it's necessarily a fantastic company with huge abilities for margin expansion. I do like that free cash flow is quite a bit higher. So maybe let's do 1.3, 1.2, sorry, share change. Pretty big share repurchases. So $236 million is 1%. 3% would be about 700, 800 with that. That'd be 40% of free cash flow. Let's do that. And then the dividend, right now, not that large, but we can probably offset it with our share repurchases. So dividend stays roughly 20-25%. They're using share repurchases with 40%, and then making acquisitions, reinvesting back into themselves to get a 6% return year over year with these type of margins. So right now it says it's right at the price point we're looking at. I'll probably do a deeper dive here. I'll definitely want some higher margin of safety given the margins on the earnings and free cash flow side, but looks interesting enough right now. So I'll have to do a deeper dive here. Hopefully you enjoy the video and have a great rest of your day. Thank you.